Finance function. Part A. Explain the relationship between an organisation's financial objectives and its business strategy. The strategy of a business will have an inherent relationship with the financial aspect of the company in three ways, in terms of financial risk, financial returns, and funding. The financial risk of the company is the risk that the company is not able to pay its liabilities to its creditors. This is translated into the gearing of the company, which determines the level of debt the company holds. Contrary to dividends given to shareholders, the debt must be paid no matter what, while the dividends are discretionary, meaning that the company chooses to give them or not. The financial risk is also represented by its liquidity, which is the solvability and cash flows of the company. Does the company have plenty of cash in the bank, or is running behind supplier payments? The financial return is simply the return on investment investors expect of the company. Financial return is not only in the form of cash dividends, but also in terms of capital appreciation, with the company's share price going up in value. The funding of a company will be a central topic of the board. Funding can be tailored to manage the risk of a company. For example, funding can be done through venture capital, which is perceived to be a high financial risk, through equity, which is a little bit better, through a mix of debt and equity, which translate into medium risk, and finally through debt only, which brings also a high level of risk. Part B. Discuss how advances in information technology has transformed the finance function and the role of the finance professional. In the past, finance professionals were heavily relied upon for very pedantic and repetitive tasks. The production of financial reports and accounts were done manually and required not only a high level of skill, but a lot of labour and time. Technology has transformed the profession in recent years by allowing it to automate these repetitive tasks and improve on the production of financial reports in efficiency and effectiveness. Cloud-based solutions are now increasingly popular and prevalent in all businesses. The premise of a cloud-based service is that the data and software are stored on the cloud, as in the provider's servers, and accessed through the Internet. Internet penetration has allowed this phenomenon to happen and allowed users to benefit from the provider's security and infrastructure, and not deal with it themselves. Big data is a development that has disrupted many industries and professions, including the financial profession. Big data allows instant access to huge pools of data, real-time, and powerful analytical ability of said data. Predictive software also allows for forecasting and modelling financial performance and results. Another recent trend is the apparition of fintech, which refers to financial tech, an uprising in financial services companies with disruptive technology. Part C. Evaluate alternative structures for the finance function using business partnering, outsourcing, and shared or global business services. As we have seen above, the finance function is not only a less labour-intensive department of a company, but the role of a professional has tremendously changed. The finance function is not really a unit of production of reports, but a business partner which understands and conveys what the reports show, and help management in the decision-making process. This is why companies are starting to change the structure of the finance function into a more business partner foundation. The function can also be outsourced altogether to a third party specialised in the field. Also, companies are using what is called a shared business service, which is simply the finance function being shared with multiple divisions and layers of the group company.